Click the bell icon to get latest videos from Ekeeda.
Hello friends, when new partner is admitted, all partners' capital may be adjusted as per their new profit sharing ratio. Any excess or shortage in case of old partners' capital is adjusted through loan account, current account or cash account. In this problem, it is adjusted through bank account. How to give effect, that will be understanding in this question. Let us go through the question. Raj and Dev are partners sharing profits and losses in the ratio of 3:2. Their position on 31st March 2011 is as under: assets, building, furniture, stock, debtors, RTD, bank balance. This account will be opened. On debit, we'll be putting it as what? Opening balance. Capital account of Raj and Dev, it will be credited to capital account. Creditors, bills payable, general reserve. Usually general reserve is accumulated profit which is distributed among old partners in their old ratio, that is 3:2. So it will be 9,000 and 6,000. 9,000 will be received by Raj and 6,000 by Dev. On 1st April 2011, they admitted Manoj on following terms. Manoj should bring in cash 1 lakh as capital. So amount is received in cash, bank account debit, Manoj capital account will be credited for 1/5 share in future profits and 25,000 as amount of goodwill, that is goodwill brought in cash. Building should be revalued for rupees 1,25,000. Here building we have 1 lakh, so we are required to add 25,000 to the value of building. Second effect it will have on revaluation account credit side or profit and loss adjustment account credit side. Furniture to be depreciated at 12.5% per annum. So furniture is 10,000, 12.5%. So it will be 1,250. This will be deducted from furniture. Second effect, profit and loss adjustment account debit. Stock 10%. Stock is 31,000. So you have to deduct 3,100 from stock. Second effect, profit and loss adjustment account debit. RDD should be maintained as it is. As it is means there is no change. As there is no change, nothing to be changed, there will be what? No entry for this adjustment. The capital account of partner should be adjusted in their new profit sharing ratio through bank account. Prepare profit and loss adjustment account, capital accounts, balance sheet of new firm and show how you have calculated new ratio and new capital. In this case, question itself is asking to show calculation of new ratio and new capital. So we are required to show it as a part of answer, calculation of new ratio and calculation of new capital. First we will do working note for calculation of new profit sharing ratio and calculation of revised capital of old partners. Old profit sharing ratio is 3:2. New partner is admitted for 1/5 share. For calculation of new profit sharing ratio, we need to complete 2 steps. First step, find balance of 1. Formula is 1 minus new partner share. New partner share is 1/5. That is 1 minus 1/5. 1 minus 1/5 is 4/5. That is finding balance of 1. New share of old partner is equal to balance of 1 multiplied by their old share. Balance of 1, 4/5. Old ratio of Raj is 3/5. Old ratio of Dev is 2/5. So Raj, 4 multiplied by 3, 12. 5 multiplied by 5, 25. So new ratio of Raj is 12 by 25. New ratio of Dev, 4 multiplied by 2, 8. 5 multiplied by 5, 25. 8 by 25. So in future profit, if we have 25 parts, 12 parts will be given to Raj, 8 parts will be given to Dev. Out of 25, 12 parts are given to Raj, 8 parts are given to Dev. So what balance remains? 5 parts. That will go to new partner. So share of Manoj will be 5 by 25. That is 1/5. So we got new profit sharing ratio here. Raj, Dev, Manoj, 12 is to 8 is to 5. This is calculation of new profit sharing ratio. In this question, goodwill is brought in cash. So we need to calculate sacrifice ratio for distribution of amount of goodwill brought in cash. Formula for sacrifice share is old share minus new share. Here in case of Raj, old share is 3/5. New share is 12 by 25. In case of Dev, 2/5 minus 8 by 25. Sacrifice share we get in case of Raj 3 by 25, Dev 2 by 25. Finally it is 3 is to 2. So goodwill brought in cash by old partner will be distributed in this ratio 3 is to 2. Let us calculate now based on new ratio, new capitals of old partners. New capitals of old partners. For calculation of revised capital, we are required to take following steps. Find total capital of new firm. Capital brought by new partner multiplied by reciprocal of new partner's share. Manoj brings in cash rupees 1 lakh as capital for 1/5 share. So capital brought by new partner Manoj 1 lakh for 1/5 share. So we are required to get reciprocal of new partner share. So share is 1 by 5. Reciprocal will be 5 by 1. So it will be 5 lakhs. Based on this total capital of firm, we'll be calculating revised capital of old partners. We are required to find total capital of new firm, that we got 5 lakhs. Now Raj's new capital will be total capital of new firm multiplied by his new share. Total capital of firm is 5 lakhs. New share of Raj is 12 by 25. So new capital, revised capital is 2,40,000. In case of Dev, 5 lakh multiplied by new share 8 by 25. New capital is 1,60,000. That total is 4 lakh plus 1 lakh capital of Manoj. That is 5 lakh is total capital of new firm. Raj and Dev are partners sharing profits and losses in the ratio of 3 is to 2 respectively. Their position on 31st March 2011 is as under. Capital of Raj and Dev. This will be posted to their respective capital account on credit side. Partners capital account credit by balance brought down. Raj 1 lakh, Dev 75,000. Relating to partners capital, we have general reserve 15,000. It will be divided in the ratio of 3 is to 2. That is, Raj will get 9,000 and Dev will get 6,000. Partners capital account credit by general reserve. Raj 9,000, Dev 6,000. Creditors 10,000. There is no adjustment on this item. This will be recorded in new balance sheet as it is. Liabilities, creditors 10,000. Bills payable 5,000. There is no adjustment on bills payable. Bills payable 5,000. Asset side we have building. There is adjustment on building. Amount is 1 lakh. This is recorded on asset side. Building inner column 1 lakh. Furniture 10,000. There is adjustment on furniture. Stock 31,000. There is adjustment on stock. Debtors 50,000. There is adjustment, but it says that there is no requirement of change in RDD. So debtors and RDD will be recorded as it is. Debtors 50,000 less RDD 1,000. Net debtors 49,000. Bank balance 15,000. Bank balance will be recorded as opening balance over here. To balance brought down. To balance brought down 15,000. On 1st April 2011, they admitted Manoj on following terms. Manoj should bring in cash 1 lakh as capital. Amount received 1 lakh will be recorded to the debit of bank account. To Manoj's capital account 1 lakh. This will have second effect to the credit of Manoj's capital account. Manoj capital account credit by bank 1 lakh. He should bring 25,000 as amount of goodwill. Amount of goodwill brought will be recorded to the debit of bank account. To goodwill account 25,000. This will have second effect to the credit of goodwill account. Goodwill brought in cash, cash account debit to goodwill. This amount of goodwill will be distributed among old partners in sacrifice ratio. Entry will be goodwill account debit to old partners, that is to Raj, to Dev. Goodwill account debit to Raj capital account 15,000, to Dev's capital account 10,000. Goodwill account gets closed here. This will be transferred to their capital accounts on credit side. Partners capital account credit by goodwill. Raj 15,000, Dev 10,000. Building should be revalued for 1,25,000. Value of building is here 1 lakh. We'll have to add 25,000 to it. Second effect will be profit and loss adjustment account credit. Revised value of building is 1,25,000. Second effect, profit and loss adjustment account credit. By building 25,000. Furniture 10,000. Here they have said depreciate furniture at 12.5%. So we have to reduce 12.5%, that is 1,250 from amount of furniture on asset side. Furniture 10,000 less depreciation 12.5%, 1,250. So now net value of furniture is 8,750. 1,250 will be recorded to the debit of profit and loss adjustment account. Profit and loss adjustment account debit to furniture 1,250. Stock to be depreciated at 10% per annum. Value of stock is here 31,000. 10% of it 3,100. One effect will be we have to reduce stock on asset side by amount 3,100. Stock 31,000 less depreciation 3,100. So net is 27,900. Second effect of this depreciation 3,100, revaluation account debit side. RDD should be maintained as it is. So there is no change in the amount of RDD. 1,000 it will remain same. So there is no adjustment. So there will be no any entry for this or effect for this. The capital accounts of all partners should be adjusted in the new profit sharing ratio through bank account. We have already calculated new capitals of partners as working note. Prepare profit and loss adjustment account, capital account, balance sheet of new firm, and show how you have calculated new ratio and new capitals. We already done working note for that. Let us close first now profit and loss adjustment account. To the debit of profit and loss adjustment account, we got balancing figure 20,650, which shows profit. This will be divided among old partners in their old ratio 3:2. So share of Raj 12,390, share of Dev 8,260. This will have effect to the credit of their capital accounts. Partners capital account credit side, revaluation profit is transferred by profit and loss adjustment account. Raj 12,390, Dev 8,260. We can close now partners capital account. We'll record required capital first. As per our working note, required capitals are Raj 2,40,000, Dev 1,60,000. Partners capital account debit, to balance carried down, Raj 2,40,000, Dev 1,60,000, Manoj 1 lakh. These are revised capitals which will be transferred to balance sheet. This we got as per our working notes. Capitals of new partner Raj 2,40,000, Dev 1,60,000, Manoj 1 lakh. Total amount is 5 lakhs. We can now close partners capital account. We have closed partners capital accounts. We got balances on credit side. In case of Raj, 1,03,610, Dev 60,740. These amounts they are required to bring as it is a shortfall of their capitals. This will be brought in bank account. So bank account on debit side will be recording these amounts now. Bank account debit side to Raj's capital 1,03,610, to Dev's capital 60,740. This is for amount brought by old partners to maintain their new capitals. Now we can close bank account. We have closed bank account. We got balancing figure 3,04,350 on credit side. This will be transferred to balance sheet asset side. Bank balance 3,04,350. Now we can close balance sheet. Asset side total we got 5,15,000, which is equal to liability side total 5,15,000. That means balance sheet is tally. In this question, we learn how to give effect to partners capital adjustment when new partner is admitted and adjustments is done through bank account. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda.